I'm Helen from Time to Resources. In this video, we're going to look at understanding the public and the private sector within the economy. The public sector is all of the organisations that are owned by the state or the government. The private sector is all of the organisations owned by individuals or groups in society. So the public sector is owned by the state. In the UK, this is the government, gov.uk. This would include services such as fire and police, the National Health Service and state-owned schools. The public sector is funded in different ways. One source of funding is taxpayers, e.g. individuals paying income tax, businesses paying corporation tax, duties charged on goods such as petrol and VAT on goods such as food. It could also be charges, for example, individuals who pay for their prescriptions or applications for a passport. The final source of finance for the public sector is the selling off of state assets. This can bring a large amount of finance into the government, for example, when water companies or British Gas have previously been sold off. Public sector organisations are often not for profit. In the UK, after World War II, there was a programme of nationalisation where a number of industries were moved from the private sector to the public sector. Reasons for this included to supply services which were unprofitable, such as steel, gas and coal, to protect jobs, and also in order to stop customers from being exploited, as some of these businesses, such as water, would have had monopoly power. Public sector organisations also operate to benefit society. This can be in the provision of public goods. Public goods are ones where, if the consumption is made by one person, it does not reduce the amount available to a second person. And once they're available to everybody, for example, street lights. Merit goods are those that are deemed to be good for society as a whole, e.g. education. It is thought that the provision or take-up of these would be too little if left to the private sector to supply them. The private sector is all of the organisations owned by individuals or groups in society. If a business moves from the public sector to the private sector, this is called privatisation. Private sector businesses are funded by private investors, for example shareholders. One argument used in favour of privatisation has been that it encourages the public to own shares, which helps to build wealth in society. These enterprises are funded by shareholders, owners' capital and retained profit, i.e. profit kept in a business to fund future activities and maybe growth. These private investors will want a return on their investment. Therefore, many private sector businesses have an objective of profit maximisation. In order to achieve profit maximisation, they will try to increase efficiency. A negative side of this may be that in order to cut costs, they reduce staff levels or relocate abroad. However, the increased efficiencies may lead to better quality services or more choice for consumers. Legal structures within the private sector include sole traders, partnerships, private limited companies who can sell shares to family and friends and have Ltd after their names, and public limited companies who can sell shares on a stock exchange. Sometimes in examinations students get confused here. A public limited business is in the private sector because they are owned by private individuals and groups. Thank you for watching this video on understanding the difference between the public and the private sector. If you haven't already done so, why not subscribe to the Time to Resources YouTube channel now? Another of our videos looks at categorising businesses by whether they are part of the primary, secondary or tertiary sector.